But what is our next guest looking at? Nuveen Chief Equity Strategist, Senior Portfolio Manager, Bob Dahl. Bob, I always look at what the Treasury market is doing. The 10-year Treasury yield was back below 2.1% yesterday. And the markets, the futures market, is pricing in an 89% chance that the Fed will cut rates next month. So that's incredible. If you think that the Fed needs to cut rates next month after raising them in December, why is the market the stock market not shakier?
That's a great question. When you throw up the Fed, the issues of trade and the uncertainties, and now we're adding what's going on in the Middle East, it says, okay, what are second quarter earnings going to look like and the balance of the year projections, Dagan? And I can't imagine we're going to get more good news. We might get some more negative news. So I think the stock market is a bit vulnerable given all you and I have just said.
Bob, it's Kevin Kelly here. And so you were talking about the stock market. One of the things that's weighing on it today is actually what came out of Broadcom and talking about the implications of what's happening, for the second half of the year, as you alluded to, especially because of the Huawei situation. Then we've got regulation risk happening in tech, right? We've got the FTC, we got the Department of Justice looking at Facebook, Google. So we have that weighing on the tech sector. I mean, are we going to have a really hard time with market leadership in the technology space to get us to a 3,000 level or a 2,900 even?
I think so. I think we're going to have a lot of rotation, the absence of leadership, which is generally more negative than is positive. And, you'll get 600 CEOs writing to the president about something if they don't care, given their businesses. So we got question marks out there, and that the market continues to flirt with all-time highs is a little risky in my view. I don't want to be overly negative because I don't think we're going into a recession. But on the other hand, risk-reward is a little concerning for me.
Bob, Lindsay Bell here. I'm just wondering what your take is on what Dagan mentioned, the expectations for the Fed to cut rates. We know that the market usually performs very well in the 6 and 12 months following a rate cut cycle, especially if we aren't in a recession. Do we need a rate cut at this point? Economic data is still there. Sure, there's areas and pockets of weakness, but economic data still remains strong. The consumer is still very strong. Is this the next move that the Fed needs to take?
That's a great question, and obviously that's the debate. I am surprised the probability of a cut is that high. I think the Fed is saying, look, maybe we didn't or shouldn't have done December. Maybe we could take that one back for the word insurance, as we've heard. If we're going to get several Fed cuts here, some are saying as many as 3 in the next 9 months, that means there are going to be a lot of economic and, more importantly, earnings disappointments. That's what we have to be worried about. So I agree with you. In the rearview mirror, the economy looks okay. But we go forward, we certainly have uncertainties, and therefore the opportunity for a debate, are we okay or not?
Bob, can I quickly just ask about those earnings disappointments real quick? Is that going to be because companies' margins are going to shrink because they're having to consistently reinvest in their businesses to generate organic growth? Vis-a-vis, let's talk about Google. They're spending $13 billion on data centers because they want their online gaming platform Stadia, right? Is that the real concern here, that companies just have to pour so much money to generate top-line revenue?
That is certainly part of it. You can't have wage rates moving up more than 3 and not have labor cost pressures in addition unless you get really good productivity. But I think part of it is the uncertainty going forward, and therefore businesses and CEOs kind of pulling back on future spending until they get a better idea of the landscape. I think that's the question mark.
Bob, you're clearly concerned about equities right here. Where do you put new money to work? Because again, do you really would you put cash into a 10-year Treasury with the yield below 2.1%?
I don't think, I don't think that's a great bet either. So I'm going to have a little powder on the sidelines, awaiting an opportunity to buy a little bit lower, in my view. And if stocks continue to go straight up, at least I got a bunch of money invested. So I think a little caution probably makes sense.
Where would your cash allocation be here?
Whatever normal is for you, I'd have 5 to 10% higher than that. Look, right. The stock market hit 2950 January of last year, last fall, and a few weeks ago. We're kind of stuck. We're making no progress, and so we need some more good news to break through, and the market's got to sort out what that's going to be, and it may take a while.
Jack, do you have a quick question?
Yeah, Mr. Doyle, Jack Brewer. The IPO market has continued to be hot. Do you think you're going to see a slowdown anytime soon? And kind of give me your assessment on that, please.
Yeah, as long as the stock market stays 2850, 2900, IPOs will be fine. If we get more weakness, then the IPO market will pull its horns back in. But you're right, it's been fast and furious, and there's a lot of money on the sidelines for these deals.
Bob, good to see you. Bob Dahl, always
All the best.
a pleasure, sir.